Hi, everyone. I'm Rick Bensignor. Today is Tuesday, January 4th, 2022, and welcome to this week's In the Know Trader Show. What do we have on tap? Well, we're going to be looking at a open interest, and this is part two. We started this mini series off in our last show, which was the middle of December, before we were on a 2-week hiatus. So we're going to continue looking into open interest, what it is and how to interpret it. When we get to our market part of the show, we'll take a look at what the Dow Jones is doing, the US 10-year and the dollar index. And then we'll take a look at a bunch of popular futures markets when we go through the charts and specifically relate them to the open interest for each one of these contracts. So you got gold, silver, HG is high-grade copper, CL is crude oil, natural gas, corn, soybeans, wheat, live cattle, and Bitcoin. And we'll try to get to as many of those as possible. We put out a weekly ETF Tactical Trader report here at In the Know Trader. Comes out usually Thursday nights, occasionally over the weekend. And what we do is give you a macro look at the markets, especially a deep dive into the S&P, but we'll look at bonds, credit markets, gold, the dollar, etc. This deep dive into the S&P and all the key levels there, plus give you a new ETF trading recommendation each week and update you on all open positions we have until they get closed out. Subscription information available at intheknowtrader.com, and also our monthly 7-Eleven report. That's a report intended, the goal there is to beat the S&P's return on an annual basis. We do this by being in no less than 5 nor more than 7 of the 11 macro spider ETFs that represent each one of the macro sectors. And to date, so this report started in August 1st of 2020. To date, we've outperformed the S&P by 390 basis points. In our current fiscal year, after having a lousy December, we're still, so from August 1st through year end, we're still outperforming the S&P by 71 basis points. Decembers and Januaries often have very atypical type sector movement because you're ending the year, and a lot of portfolio managers switch things around to often make it look like they're in sectors that they might not have been in, especially those that they underperformed in. And of course, January gets all the new allocations by portfolio managers. So things often move around quite a bit the end of the year and the beginning of the year. But we generally have a medium-term outlook. So the fact that in December you saw for the first time in probably all of 2021, the classic kind of 4 defensive sectors of the market well outperformed the S&P, and that was Omicron related. That's we're more in the growth and cyclical part is where we have our investments, and that's why we underperformed. But nonetheless, we still did beat the S&P. We continually beat the S&P as far as our fiscal calendar year, and certainly since we started a year and a half ago. All that information available at intheknowtrader.com. Okay, so let's start off here with what is open interest and how to interpret it. So I'm just quickly going to review what we had talked about in our last episode. The total number of outstanding futures contracts commitments divided by 2 is the open interest. So again, for every long in the futures markets, there is a short somewhere. So if you count up the total number of long and shorts out there and divide by 2, you have open interest. So how do you create open interest, and what's an increase in it? Well, a new long that gets paired off against a new short. So if I buy, let's say I buy a gold contract, well, who am I buying it from? The seller is either a new short, and they're short because they think gold is going down, or they used to be long gold and now they're getting out. So that's the only 2 ways you can be a seller, right? You're getting out of a prior long, or you're simply going short. If a new long matches up against a new short, open interest goes up by 1 contract. If I buy 5 contracts and 5 are on the short side, then open interest goes up by 5. But when a new position comes on long versus a new position short, open interest goes up. The exact opposite happens when an old long is exiting to somebody who used to be short who's now buying, right? So the old long is selling to get out of their long position. The prior short is now buying back to get out of their prior short. Both are essentially walking away from their commitment to the market. Open interest goes down by the amount of contracts that those are paired off against. And then these 4 bullet points that are in yellow don't change open interest. So if I'm a new long coming in and I buy a gold contract in the futures market, but the person selling it to me had previously been long and is getting out, the open interest doesn't go up, nor does it go down. It essentially does nothing. If a new short selling to a prior short, so somebody comes in as a short and the person they're selling it to used to be short, so they're getting out, then open interest doesn't change. A prior long getting out to a new long coming in doesn't change open interest, and a prior short buying from somebody who's a new short doesn't change. So the only way open interest goes up or down is when both get paired off as new positions or both get paired off as old positions. That's open interest and how it moves up or down. So if I pull up, for instance, here is a chart of gold. This lighter blue line, in fact, let me take off the moving average here because we don't need it right now. This is the open interest in gold, which is about 500,000 contracts, right? Currently, it's at 507,899 contracts. That's how many long positions there are. And it's another way of saying that's how many short positions there are, because there is a long for every short. So there's 500,000 commitments that in the market that gold will go higher, and 500,000 commitments that gold will go lower, and that's why they're short. The change in open interest is often what we care about. So, and how it relates to what the market's doing. Notice that when, we'll do a little here, when gold broke out above, right in here where my arrow is, where it broke out of this kind of shorter term triple high at a little north of 1800, where it was about 1810 or so, this broke out, gold broke out to the upside. It then took out another 1-2 triple top, which got a further surge. And what this shows you in open interest is that new longs came into the market on that move. Now, of course, if new longs come in, essentially because there's got to be a long for every short, it means there are new shorts coming in, but the shorts were losing money. How do I know? I know the shorts are losing money because price is going up and new shorts have come in. So the ones who came in early into this rally were losers. And eventually, gold tests the downtrend line from January of 2021. One of the many downtrend lines you can draw, but this one happened to be kind of the most recent of downtrend lines you could have drawn at the time. And for many days, gold stalls against that level. So when a rally stops going up, you know, you've got sellers coming in. Now, who are some of these sellers? Well, based upon open interest, I know that there's buyers in here, and I know there are sellers, and they're kind of getting nowhere price-wise, but I can look at open interest and see there's a point to which open interest started coming off as price started coming off, which means that, what's it mean when open interest goes down? It means that prior longs got out to prior shorts. Both were leaving the marketplace. So shorts who were losing money were coming in, and as this started coming off, they were getting out and taking their losses. But as we started selling off more, the longs that had come in, not just from the breakout, but also all the ones that came in here, anticipating a move higher that didn't happen, they're now getting out with some losses. And what we see is that open interest came right back down to basically a 500,000 contracts area, the level it had been at before this rally occurred. So we know that new commitments came in and that those new commitments also came out. And you don't always see this exactly track the market. So you often get a good sense of the validity to a move in the market, a price move, by looking at open interest to see, are new buyers committed and are they staying with their positions and adding to their positions? Or is there a point at which open interest starts coming off even in the depth of a rally? And when open interest comes off in the depth of a rally, it often means that shorts are paying up and covering and essentially locking in their losses. They're getting out of losing positions that they feel like they don't want to hold any longer, and they don't want the pain of being short in a market that keeps moving higher. So looking at open interest is often a way to get a sense of how strong a rally is. Let's go back in time. We look at July of 2020 in the summer, and gold started rallying, breaks out and zips higher. You'll see that open interest moved up almost along with it, which means that this rally had lots of new longs coming in, and these were probably funds that bought into the market, like commodity funds and speculators, pushing up the price of gold. Now, again, there's a short for every long, so you've got people on the wrong side losing money. Gold reaches a peak, as it did in August 2020. In fact, that's the all-time high, gets a big spike down, and then starts consolidating. And what you see is just even before it peaked in price, look where open interest peaked here. Actually, if I put so right about here in July, look where price is relative to what happened. So open interest is going down, but price is going up. What's that means? It means that prior longs are getting out to prior shorts. And during this phase where the price kept going up, you're seeing more and more longs getting out, as well as shorts getting out. So that gives me a sense that this rally doesn't necessarily have what you really want to see if this were going to keep going higher, because you wouldn't really see the longs be getting out. If they really believed the market was going to keep going higher, they'd hold their long positions. By looking at open interest, we can see that during this rally, it's actually going down. So you have the super strong rally where gold is surging higher, and yet open interest is telling you that the longs aren't kind of buying, and let me use a different word, because I mean like believing in, like buying into the bullish gold story, because they're actually selling out even though price is surging. So the shorts are really getting squeezed. They get to a point where they say, get me out, I can't take the pain of being short anymore. Just buy it. You know, often they buy at the market because they just want out. And they're closing out of positions, but the longs are also closing out of positions. And that happens, you know, well, only halfway up into the rally, which means the rest of the rally are shorts that just keep buying to finally get out. But as they're buying to get out, the longs are getting out too. So it's telling you that the longs don't believe that this is going to keep going higher. Essentially, smart money was selling out into this rally. And then you consolidate in price and you consolidate the open interest, and then you take a dive in open interest, which coincided this time with a $250 to almost 300. Yeah, we went from 1950 down to 1675 in price. And you see open interest came way off, which means both longs and shorts got out of their positions. So in this case, shorts are covering into longs who are stuck, and they're both leaving, which means the shorts don't think that we're going down precipitously. And sure enough, you know, we end up getting, price-wise, you get a double bottom and a move back up. And then you got this spike that we talked about earlier. And notice that open interest went from 500,000 or so to over 600,000 very quickly, reaching essentially the same heights, if not even slightly higher than what had been last summer's. So a huge amount of open interest came in here, only to immediately come out on the decline as price couldn't break above the trend line. So looking at open interest can give you a sense of what the players are doing. So when we talk about players, we know there are buyers and sellers, but there's also players who we can actually define better who the players are. And to do that, we go into a report that gets released by the government on a weekly basis called the Commodity Futures, the CFTC's Commitment of Traders Report. So let me see where, I know I have that. Yes. So here, I'll go back. Here's the website, cftc.gov. And you go into the markets tab, market data and economic analysis, and you go down to the Commitment of Traders tab. And when you do, you'll see, as you scroll down here, that it breaks out the different commodity futures contracts by what type: agricultural, like corn, soybeans, wheat, oats, things like that; petroleum, like energy, natural gas, they have in a separate one; petroleum, so crude oil, RBOB, gasoline, and some other ones. You have natural gas, electricity, and metals and other. Plus you have a whole separate one for financial and stock indexes, as well as, if I remember, there's also, well, within financial, you probably have the currencies. So anything that's a futures market ultimately gets categorized into one of these. And I don't know what that was, but let's take a look. I go to metals and the short format. So I click on short format and it brings me to this page. Here on the left-hand side, palladium, come down as platinum, silver, and here, let's take a look at gold. So this report was updated with information as of December 28th. It usually comes out a few days later than the date because it takes time for them to compile this. But here are the players and what you need to know when you look at open interest. Producers, the first category of who are players is producers or merchants or processors or users. In other words, these are the people in the gold industry. They're either producers of gold, they're merchants within the gold industry, they're gold processors, and easier to understand a processor, let's say, in terms of if it's an agricultural product, or let's say the energy side, refiners, and actual users. So these are people, none of these people are speculators. These are people in the industry of this particular commodity, in this case, gold. So these guys are considered smart money. Take a look at the open interest commitments they have. The gold producers, merchants, processors, essentially those in the industry, have 11,000 contracts on the long side. See this thing here, long, but they have 69,000 shorts. There's 6-to-1 short to long, which is not, it means they definitely are willing to lock in the price of gold, the forward price of gold through the futures market, because they are not tremendously bullish. How do we know they're not tremendously bullish? They're way short relative to what they're long. Now, there's often a natural skew to this category having a short basis because, for instance, if you're a farmer looking at, you grow corn, the only thing you're going to be interested in is locking in the price of corn that you have grown in your fields, so you're a natural short. Processors tend to be more on the long side because they need to buy the good to process it. But there's generally a slight skew to the short side, but not 6-to-1. So this is telling you that the people in the industry don't think the price of gold is going up dramatically. For if they did, they would probably not put out as many short contracts at current prices. Swap dealers. Now, this is a role on Wall Street of being often the opposite side to either managed money. Managed money is the speculative side, but coming through funds, and other reportables are individuals like you and me, smaller speculators. So swap dealers are dealers on the street who are taking the other side to either managed money or potentially some of the people on this side. Where are swap dealers? They're long 74,000 contracts, but they're short 260,000. So there's a huge, these guys are going to lose money when the market goes higher. Now they're in swaps, but look at, by the fact that they're more than 4-to-1 on the short side, and the producers are 6-to-1 on the short side, says that managed money is very long, as well as potentially the smaller people. So let's look at managed money. They're long 130,000 contracts, and they're only short 46. So they're essentially 3-to-1 long. And then look at other reportables. The little guy, and if you have, I think it's less than 50 contracts of open interest, you're considered a little person in the futures market. So that's all of us listening to this. They are now long 100, almost 174,000 contracts versus short about 44. So they're about 4-to-1 long. So what's this tell you? Managed money, the commodity funds and individuals are long gold, dramatically long, net long, by, again, the tune of 4-to-1 here, by the tune of 3-to-1 here. So they're very long. And who's on the short side? The dealers on the street, as well as the merchants. So that gives you a clue more towards the fact that speculators have pushed up the price of gold, or maybe not even pushed up, but they are where the long exposure is. And speculators have much less deep pockets than do the people in the industry, the huge companies. So if there's bad news that can affect the price of gold, gold could come off very quickly because it's speculators, whether managed or individuals, speculators are long versus supposedly smarter money, which is short. So that's one element to looking at this. The next is the changes from week to week. And it's interesting, I'm looking at how much time we have left, and we're not going to get to any of the charts again, because this is a very important category of information for you guys to understand. So it is going to take up the whole show. We've only got a couple minutes left. Take a look. Changes from last week. The producers and merchants reduced their longs by 646 contracts, and they added to their shorts by 1,714, which is really another. So if they're less long and they've added to the shorts, they're even take the amount they're less long and add it to the shorts. They're that much more. They're 2,360 contracts more bearish. The swap dealers went less long and added to their way more to their shorts. That means they're also not truly expecting huge price increase, but again, swap dealers are really more taking the other side. They're not as opinionated per se, but more acting as a function, as a middleman. Managed money increased their longs by 6,000 and over 6,200 contracts, as well as reduced shorts by 5,600. So in this case, when you add to the longs and reduce shorts, that's over 11,000. That's almost 12,000 contracts of new buying. And other reportables added about 1,000 longs, but added to their shorts. That's significant because here they're both on the same side of the plus minus sign. So they actually, individuals got more bearish, even though their net still very long, but they reduced, or better, they reduced their bullishness by actually net adding to short positions. And what happens is when you get speculators very, very long and price breaks, you'll often see the longs reduce and potentially shorts increase. It's a combination of looking at all of these combined that help you interpret a chart in the futures market. So it's not just price you want to look at. You also want to look at what open interest is doing. And I think what's going to happen here is that we're going to even take this into a mini part 3 next week, just to finish this up, to make sure we can put all of this information together. So next week, we'll look at charts, we'll finish this discussion, and then look at a whole bunch of different futures markets charts in order to bring the picture of open interest into how you interpret the chart itself. That's it for this week. My name is Rick Bensignor, and thank you for listening to this week's In the Know Trader Show.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.